This is a FarmDoc Daily webinar. I'm University of Illinois Extension's Todd Gleason. This is part of a two-part series. If you've joined us, or if you're watching after the fact in the archives, there is another one in the Crop Risk Management for 2024 series. You can look that up on the YouTube website. Today, we're going to talk about prices, budget, risk management decisions. Gary Schnitkey and Nick Paulson are both here. Thanks to them for being with us. And they'll take you through the next hour or so to discuss the decisions that need to be made. Gary, I think you're going to begin for the day.
That is correct. I am going to begin for today, and we're going to look at three things today: budgets, 2024 decisions, which would include our county PLC, and our crop insurance decision, amongst others, marketing. And again, as we've said a number of times, on March 4th, we will have another webinar where we go into crop insurance decisions in more detail. So those are our topics for today. And again, marketing, our PLC, and crop insurance, and then we'll go longer term. So for our context for beginning our budgeting, just a reminder that farm incomes were exceptional in 2021 and 2022. So those were our two banner years. Those were our two record income years here in Illinois. And during that period, most farmers rebuilt or built a very strong financial position. As we look at FBFM data, our debt to asset ratio has been the lowest, and our current position or current ratio have been the highest at the end of both of those years. However, and there's always a however in agriculture, we have lower prices but continued high cost. And as we'll show here, we will have higher break-even prices and likely lower returns. I guess the period that you can make an analogy to is that we think 2024 and 2025 might be a lot like 2014 and 2015, so going back to the future. So to look at that, we're going to first start with corn and soybean prices. Here's what this slide shows from 2002 with the usual ethanol build when we had higher prices. Then coming off that, again, after that ethanol build, that's what we think we're going to look at now. And then we had a couple other events, the trade conflict, COVID, and then we rebuilt prices. And those prices began being rebuilt in 2020, hit their highs as we recovered from COVID. China rebuilt their hog herd, and the Ukraine and Russia conflict or war happened, and we hit our highs. And since those highs in of $18 for soybeans, $8 for corn, we have been on a steady downhill decline. And that downhill decline, according to our numbers here, which would be 2 weeks ago, and we're not going to put up more recent numbers because they're lower than that even now. So $4.30 for corn, $11 for soybeans, and if we're looking. And so those are low. And again, new bid from February 12th, $4.15 for corn and $11 for soybeans. So seeing those decline again, that's pretty typical after some highs. We're seeing Brazil have a relatively good year, not the best, but still record production. And at this point in time, we would be looking at a good production here, or that would be the expectation. As a result of that, our market year average prices for the next couple years are going to be projected down. For 2022, 2023, the marketing year that ended in August, we had $6.54 for corn. We are projecting $4.80 for this production year. Actually, USDA is projecting, which seems about right. $4.80 for corn, $12.65 for soybeans for this production or marketing year, and that's down from $14.20. So you can see there, both of those prices are down a couple dollars, and obviously that's going to reduce revenue and income as well. And we're projecting that decline to continue into 2024, and those are based on USDA forecast. If you look at bids right now, they would be roughly in that same range, maybe a little bit lower if anything, but in that range $4.40 for corn, $11.20 for soybeans, and $6 for wheat. So all those are coming down. That isn't new news, but it still continues to be something we have to get used to. And if anything, perhaps the quickness of the decline was surprising, and the way those prices have declined through the first part of 2024.
Yeah, and I think, we've got the 5 marketing years, the historicals listed in the green columns from 18 to 22. Those are important to remember that's the years that are working into the effective reference price calculation for PLC now, as well as the ARC benchmark price for the ARC program. And yeah, obviously much higher prices in 2022 and 2021 marketing years. And we're kind of back down to where we were, a little bit lower on corn than in 2020, a little bit higher on beans and wheat. And again, I think that context is important. 21 and 22 were not the norm. We're probably back down in that range of what we would think would be more kind of normal longer term prices. And I think that's important for kind of budgeting and thinking about the year and the years ahead.
Yeah. So turning next to production cost, and we're going to look at those for Central Illinois, although if we look at all regions for Illinois, they follow roughly the same trends. We hit all-time highs in production cost for corn and soybeans in 2023. Those highs, and this is showing non-line cost, those highs happened in that year because of high fertilizer prices and rising cost across the board. For 2024, we're projecting some relief in those costs, and we're projecting $812 for corn, $517 for soybeans. Again, that would be down. That would be a decline. Again, if you're thinking about this, think about that 2012, 2013, 2014, and 2015 period. We're seeing perhaps a continued glide down in costs, but not going back to the levels that they were before. So that's what we're looking at. And fertilizer prices have come down. We actually had some of our lowest prices last fall. We were at $600 for anhydrous ammonia. That was down significantly from well over $1,600 in 2022. So that the $600, we have since rebounded some, and we're now at $800 for anhydrous ammonia. This is according to the Illinois Production Cost Report. $800 is a lot better than $1,400, but it's still high from a historical perspective, and actually from a anhydrous or natural gas and corn perspective, that's probably a bit high as well from a fundamental standpoint. But that's where we're at, and I wouldn't expect much relief of that going into spring. Diesel fuel prices, again, have come down from highs of $5.30 in April through July of 2022. We're down at $3.11, which is better than $5.30, but still, from a longer historical perspective, that $3.11 per diesel fuel price per gallon is still a relatively high price. So you have on the side, we have prices coming down, and we have those reflected in these budgets. And Nick isn't keeping up with the budgets because 2024 is probably a bit optimistic now, but it is where we are. So
we got red numbers already. So I don't know if bigger red numbers would be helpful to look at this point or not. But
yep. So we're showing that gross revenue, and just focusing in corn, we had $1,506 per acre in 22, $1,076 for 23, and $1,022 for 24. And non-land costs have went from $808 in 2012 to $857 in 23, and now we're projecting those down to $812. Needless to say, the revenue has come down more than the cost, and operator land return for corn is $210 in 24 projected per acre, a $363 per acre land cost, which is the average cash rent, and you get a negative number. minus 154 for corn, minus 52 for soybeans. So those numbers are negative, and that is where we're at. So this would say that the typical rented farmland in Illinois is going to lose money, which is probably where we're at. If you take the rent out of there and look at owned land, there would still be a return if we don't have all that high of you would probably have $100 of ownership cost, including the property tax and whatever debt you had on it. So in any case, the break-even prices this year are high. Non-land cost was $358 and $718. So that's without considering the land cost in there. And if we add an average cash rent, $518, and for corn, $5.18, then that would be given a trend yield, $12.22 for soybeans. And again, prices would be below that now. And so we're looking at lower returns. Those break-even prices, it's amazing that if you would go back to 2015 through 2018 and said that, you would have been, yeah, those are very high compared to those prices.
Yeah, and again, we're kind of focusing on Central Illinois numbers here today. We have gone into more detail on some of the other regions in some previous presentations this winter, but again, the numbers change a little bit across regions, but the trends and the patterns are the same. The negative returns on rented land are the same, and these break-even prices are pretty much in the ballpark, regardless of whether you're talking about northern, central, or southern Illinois, even maybe a little bit even higher break-evens, if I remember the numbers correctly.
Yep, and that all leads, if we're looking at operator and land returns, and we stated this on the 50-50 corn soybean rotation. You see the bars there are operator and land returns. Those were above cash rent in 2011 and 2012 and below it in 2023 and projected for 2024. Again, we're sort of thinking we're going back to the 2014-2015 period. If anything, those negatives become more negative now than back then, and that's just maybe because we're dealing with many more dollars of money today than we were before. But you can see we're back to negative returns. Whether that puts pressure on cash rent, it will put downward pressure on cash rent. Probably not enough to even those up over time, or not next year at the very least. That gives you a feel for where we're on cash rent decisions relative to operator and land returns, and we are back. 2023 and 2024, we are back with soybeans being more profitable, or projected to be more profitable than corn. We have seen that since 2013 through 2019. Soybeans was more profitable than corn. That can be attributed to the fact that the ethanol belt ended, but our demand for soybeans in the export market continued. That sort of turned around in 2020, 21, 22. China's build of their hog herd, along with Ukraine-Russia conflict, changed that around for the past several years, and now we're back in 2024. That probably won't lead to many changes in acres in Illinois, but it could outside of Illinois.
Yeah, and last week the USDA at their Outlook Forum, they kind of released their latest 2024 projections, and they seems pretty consistent with, I guess, the kind of the relative corn soybean price and these relative return signals we're getting here for more soybean acres. I think they had a increase of close to 4 million soybean acres for 2024 relative to last year, and a slightly smaller decline, about 3.6 million fewer corn acres expected in 24. Still above 90 million, 91 million, I think was the number for 24. But again, a little bit of a shift back to more beans and less corn nationally is what we currently expect here. So we're going to now kind of shift into the some of the risk management decisions associated with marketing, that ARC and PLC decision, and then we're going to just kind of initially touch on some crop insurance, some thoughts on crop insurance decisions just based where we're at now, a little over halfway through the price discovery period here in February. So we don't know anything for certain yet, but we have some indications of what those prices are going to be for 24 and how that might affect decisions and premiums and so forth. So first, before we get into this, we're going to ask a poll question here in each of these sections. So first on the marketing side, are you marketing more of the 2024 crop than at this same point as last year? Yes or no? So we'll give everybody a few seconds here to fill that out.
So the last several years, we learned to wait on marketing, and that may not be the way it's going to work for a while now.
Yeah, so I mean, there have been periods where it isn't true, but majority of the time, I think since late summer 2020, the best time to sell corn or beans would have been tomorrow. But that's definitely not been the case the last few months with where the markets have gone. Get our results up here. So it looks like the majority of folks are not marketing more of the 2024 crop than at this point last year. Maybe that's what we've been conditioned to wait and sell later the last couple of years, or we just have a marketing plan and we don't deviate from that. But 81% are not marketing more of their 2024 crop at this point than they did their 23 crop at this same time last year. All right. So on that, again, we still reference this article that Gary led from 2018, which I guess qualifies for a long time ago now. It doesn't feel like 2018 was that long ago, but this sort of was based on some survey responses of the percentage of expected production that is marketed, pre-harvest hedged at various points prior to harvest. So start of the year, on average, about 10% of the crop based on the survey is typically marketed, a little under a quarter of the crop by April 1st and about 40% by July 1st. I think, the marketing decisions that we see out there, pre-harvest marketing decisions that we see out in practice tend to be maybe lower than what we would expect if we were modeling things as economists from a optimal risk management perspective. But again, we have, I think, been conditioned the last couple of years to maybe holding off and waiting was always the best decision. And at least over the last few months and where we're looking at prices where we expect to have them head, that may not be the case. Definitely has not been the case the last few months and may not be the case moving forward in the short to medium term. So just emphasize, knowing what your break even, what your cost of production is, and then tracking pricing opportunities. There most likely will be, some rallies at some point throughout the summer here that you can take advantage of. And so tracking those and then taking advantage of them is going to be really important this year, given where we're looking at margins going to be. The other maybe point to bring up here is that if you are planning on, or if you're one of the majority of farmers that use the revenue protection plan as their crop insurance, remember that that should allow you to be more aggressive on the marketing side, because it is going to give you that harvest price protection. So if you get caught in a situation with a short crop, that RP payment should help to cover any hedging losses at higher prices that you might experience. So keep that in mind as well. We're going to shift now into the ARC and PLC decision. So 2024, we've got kind of the same decision we've been making since back in 2019 when the 2018 Farm Bill was implemented. So we're looking at the ARC versus the PLC program. We do have until March 15th to make that decision, but we are not suggesting you wait until that day to contact your local FSA office and make the decision. There isn't going to be a ton of earth-shattering information that comes in now that's going to drastically change the picture. And so we would encourage folks to do your analysis if you haven't, but go ahead and get that decision made if you are going to make any changes before the 15th. Another wrinkle that was brought up last week in the farm policy webinar with Jonathan Koppas and myself, Jonathan reminded us all that kind of that second week in March, around the 8th, I think he said, is potentially the next time we might be looking at a possible government shutdown, which could throw some wrenches into FSA office operations there in that week heading into the deadline. So again, probably best to just go ahead and get that decision made sooner rather than later. And even if there isn't a shutdown, we don't like to stress the FSA staff there right around that deadline. So again, the decision is the same one we've been facing. Most producers are going to find themselves, most situations for most FSA farms, looking at enrolling their base acres into either the PLC program, price loss coverage, or the county version of ARC County, ARC-CO. And again, this is one that is crop specific, and you can mix and match within farms on your different base acres, different crops, and you can even mix and match within crop across farms. So you could put some corn base in one farm into one program, corn base in another farm into another. You can mix up your corn and soybeans on the same farm into different programs. Obviously, you can choose everything for all base in one crop, everything for all base in both crops, or all crops if you want as well. The other option, obviously, is the ARC individual or farm level ARC program, ARC-IC. Again, that's going to be a minority of situations where that's probably the best choice. And Carl Zuloff did lead an article for us back in 2019 that did sort of a really nice job, I think, of outlining kind of some of those scenarios, some of those situations where ARC-IC might make the most sense. And so that would be, high risk farms with significant production variability. Again, 2019 was really unique because we had sort of some known things about 2019 and prevent plant that caused a lot more use of ARC-IC than would be the case otherwise. We don't know all that information ahead of time like we did in that year, but again, high risk farms, also farms that are just highly productive relative to your county. So if you've got just a really good yielding farm relative to what your county average is, that may be enough to offset that lower payment rate on ARC-IC. And then also if you are planting some non-program crops on any of your FSA farms, ARC-IC can also be attractive because you got a few more acres to play around with.
The one thing about that is that you will want to be selective with your ARC-IC farms, and if you enroll two farms in it, they combine those two farms in calculating the payments. So if you're doing that and you have a highly productive farm and one that is high risk, the two might offset each other. So you probably want to decide on one or the other strategy as you're doing that. Again, high risk and high risk would be those that prevent plant. This would look, ARC-IC looks like a good place to be when you have prevent plant on those farms.
On the whole farm.
On whole farm.
Yeah. Which you don't know ahead of time, but you have probably a sense of farms that are more likely to be in that situation. All right, so we got another poll question focused on this ARC PLC choice. So we're just curious kind of where, we'll tell you where we're leaning after the polls, but curious where people are thinking about probably enrolling their corn base acres. So ARC County, PLC, ARC individual, or maybe the portfolio approach where you've got some corn base in one program, other corn base, and maybe another one of the program options.
And by the way,
while they're doing this, Nick, just a reminder that if they have questions on any of these topic areas, that they can put those questions in, and that we do want to thank our sponsors as well. They include the TIAA Center for Farmland Research, Compeer, Corteva, Farm Credit, FS Growmark, the Corn Growers, and the Soybean Association. And Nick, looks like you have a set of numbers on corn. What do they show?
All right. Well, it looks like kind of lines up probably with what we're looking at in terms of how we think those programs might perform, given where prices are at and where we think prices might be. So about 75% leaning towards ARC County, 14% PLC, 3% ARC individual. That would probably reflect about the percentage we see in ARC individual in general, maybe a little bit higher. I don't know. ARC-IC might be closer to 1% total base enrolled. And then 8% in that portfolio approach.
the one thing is that the other thing to remember is that if you aren't changing program choices, you really don't have to talk to FSA. So if you're not changing, you don't have to make those elections. So we wanted to ask the same thing for soybeans. So we have another poll here, and let's see, is Jim getting that up there?
There we go.
Where are you at on soybeans? So again, choices are ARC County PLC, ARC IC, and the portfolio approach. And ARC IC again is a whole farm or FSA farm, so you would have to enroll all crops in one farm when you're doing that. So we will see what the voting says, and what does it say?
All right, so kind of what I would expect based on their responses for corn, even a little bit more interest in ARC County or more intention to enroll in ARC County on soybeans. A little less for PLC, ARC IC, we get the same 3%. So those people must understand how ARC IC works, because if their corn base is in it, their soybean base should be as well. And then again, pretty similar on kind of the mix and matching option with the portfolio approach. All right, so those survey responses from the attendees today, I think, reflect kind of the general thinking on where the programs are at. So here's again kind of our opinion from kind of the analysis we've done and things we've looked at and thought about for 2024. The first bullet point is one that we maybe need to change if prices keep moving the way that they have been the last few months. But we are still out of the money on these programs, so to speak, in terms of where prices are at and where we expect that market year average price to be for 2024 for corn, soybeans, and wheat. So probably still the most likely outcome is no payment from these programs. But again, I think as prices continue to move down, we see those market year average forecasts come down. We could be getting closer, particularly on corn and wheat, probably not really there yet on soybeans in terms of having any real high likelihood of a payment being triggered on any of the programs. We would probably be, looking at the commodity program decision on its own. We would probably be leaning to, or would be leaning to ARC County for both corn and soybean base, PLC for wheat, just given where those market year average price forecasts are at and some of the guarantee levels are, the effective reference price and the benchmark price on the ARC program. But there are other considerations here. And so we always want to keep reminding people, particularly in a year like this, I think there might even be more interest than usual in some of those supplemental insurance programs that are out there. And SCO, at least, is part of that group. SCO does require that those acres be enrolled in PLC to be eligible to use that SCO program. So that could impact things. And then, as always, sort of what kind of risks are you concerned about the most? And we'll look at some payment scenario tables here in the next couple slides to maybe go over, some of those outcomes and what you might be most worried about occurring in 2024.
So, yep. Again, this where we're at is where our poll results pretty much match where we would be thinking about doing this. We're now showing the Farm Bill What If tool. And by the way, what we're showing here is differing yields, county yields, and prices, what the PLC minus ARC County payment would be. So if you're looking at negative numbers, ARC County is paying more than PLC, and positive numbers vice versa. And if it's zero, neither one of those are paying, more or less.
Yeah, and just to maybe kind of walk through maybe areas of this table, because it's a lot of numbers to look at. And again, these are payment differences. They're not payment estimates for specific programs necessarily in any of these cases. But we highlighted kind of the midpoints here in the table. So 225 would be right at the benchmark yield for this example, which is Champaign County. That is the benchmark yield for ARC County in 2024. We've got yields above, yields below that. And then we did center this table at a $4 price. That is lower than the market year average. That's not a forecast or anything. I just picked that as a midpoint because it gives me a table that shows kind of some of the values across different scenarios. Basically, that
$4 price, by the way, is very close to the effective reference price for this, which you were going to say before.
Well, yes. So again, basically anything above that $4, or anything to the right of that $4 price, So the 415, 430, 445, 460, 475 price columns, those are all scenarios where PLC is not going to trigger a payment. Doesn't matter what yields are. PLC is a price program. If you're above that 401 effective reference price, there is no PLC payment. So everything you see to the right of that $4 price column is Ark County payments. So you can see that at $4, Ark County, because the benchmark price and the trigger price, 86% of that benchmark price is actually above where we think prices are going to be. That there's even Ark County payments triggered at yields even a little bit above trend there. So a $14 payment, or actually be a $16 payment because there is a $2 PLC payment at a $4 price with the 1 cent deficiency there. But then basically those bolded values in that $4 price column in red are the Ark County payment, I guess, plus $2. And then everything to the right of that, again, is the Ark County payment because PLC is not triggering support. As you go to the left of that $4 price column, you sort of get into situations where PLC is definitely starting to pay. And there's a number of scenarios there where Ark County is also triggering payments. So you can see at some of those lower yield levels and even yields above benchmark, as we move to lower prices, we get what's going on here is we've got sizable PLC payments, but even more sizable Ark County payments. So at a 385 price, we'd be looking at a $24 PLC payment. You can see in the first couple rows there would be no Ark County payment with a 250 or 245 bushel Champaign County yield. But even at a 240 bushel yield, we'd get an Ark County payment, but that PLC payment would be bigger. That's why you see the $12 difference there at 240 bushels and 385. And then as you move left, you get, larger payments from both programs. At 370, we'd be looking at a $47 PLC payment here for this example. 355, we'd go to 47. And at some point, if your prices get low enough, or again, we're not saying that these are likely outcomes, we're just saying these are how the numbers work. If you're really thinking that we could see a price below 350 in that low $3 range, that's when PLC starts to look more attractive again. Because at that point, it's not that Ark County is not paying, it's just that you reach the maximum Ark County payment, which in the case of Champaign County is about $92, $93. And so that's when you start to see, like in that last column there, that 325 price, those $24 payment differences. That means that PLC is paying almost $120 per acre because that Ark County payment's maxed, and so that's how you're seeing the difference there.
Yeah, and again, if you're looking at those scenarios, the scenarios in red where Ark County pays more than PLC, according to our models, would be much more likely than those cases where PLC pays more than Ark County. And again, PLC will pay more at those low prices, and 340 is pretty low though. So
yeah, again, I'm kind of trying to highlight here with the cursor, where I'm circling is probably kind of the most likely range of outcomes. It's not that some of the more extreme outcomes are not possible, but it's just most likely we'd be kind of around that low $4 range for prices, and around that, probably around that 225 bushel yield for Champaign. So
yep. Same thing for soybeans. So we're centering at 975. By the way, the effective reference price here for soybeans is 926. So the effective reference price is going to be higher. So it's going to be between that 895 to 935 price. That again would be a pretty low price compared to where we're at currently. This is for Champaign County, and by the way, you can download the Microsoft Excel tool and dial in your own county and see this same graph for this own county. But Champaign County soybeans, the benchmark yield is 71 bushels, which is right where we're at here. So, and again, that would be the 5-year average, trend adjusted, lagged 1 year. Olympic average.
Yeah, nothing complicated about that explanation.
Say that fast 3 times and they'll give you something similar. Again, if you're looking at where our projections would be, it would be sort of over where you see the cursor going now, and that is mainly zeros. We would say that corn has a higher chance of payment than soybeans. And again, if you're thinking about payments happening for soybeans, it's more likely going to be in the Arc County range rather than PLC. Again, the benchmark price for soybeans is $11.12. That's almost a buck higher than the effective reference price, which is $9.26. So if you begin to see prices go down below that, along with lower county yields or county yields below 71, you'll see ARC county payments and $9 at 10.95 at a 10 bushel lower yield. That moves up to higher levels at 9.75. So if we have a 9.75 price and essentially yields below average, there will be some payments, and those payments get larger as that price or as that yield goes down. The highest payment in this example is $67 per acre. It would be unusual for that to happen, because if we're looking at those lower yields, given the importance of Illinois and total production, we would be likely seeing some price response here as well. Again, as you get to extremely lower yields, you will see PLC making higher payments than Arc County.
Extremely low prices.
What's that?
Extremely low prices.
Extremely low prices. $7.75 here, and you can see those cases here. Again, it could happen, but it's very difficult to see Arc County not making higher payments than PLC when those payments happen.
Yeah, and again, even with the lower prices we have now, soybeans are the one of the three commodities we focus on here in Illinois where, the best guess is there will not be support triggered from either program. But again, probably the biggest likelihood would be from some kind of localized, yield impact in a county or a group of counties that wasn't big enough to impact the market, overall, but, some yield losses could drive some Arc County payments. But it would even need some price weakening compared with where we're looking in that kind of low to mid $11 range, combined with some yield losses even to trigger Arc County payments realistically. So again, didn't center the table at what we think is going to happen. We centered the table in a place where we could kind of talk about payment scenarios, and again, most likely on soybeans, probably no payments from either program. All right, we're going to shift now into thinking about crop insurance. And again, we don't know exactly what crop insurance is going to look like with certainty yet for 2024, but we are in that price discovery period. But we have heard a lot of talk about, costs are high, prices are down, returns are projected negative, particularly on rented land. Looking for areas to cut costs, crop insurance premiums have gotten more expensive through time with higher prices. Just curious if any of those factors or other factors that we didn't mention are going to impact your crop insurance choices for 2024 relative to kind of what you've done longer term or what you did last year. Give you just a few more seconds here to complete this poll, and we'll have Jim bring up the results for us. Here we go. And it looks like a good portion, majority, a little bit more than a majority, are probably looking at not changing their crop insurance decisions for 2024 relative to previous years. Little bit of a interest maybe in some lower coverage level on the individual plan, or maybe supplementing that with SCO, ECO. Potentially some increases in coverage level and or using those supplemental programs. And then about a quarter still are not decided, which is probably about right. We don't know what projected prices are going to be yet. And so those decisions will get finalized as we get into the first couple weeks in March. So we'll just remind everybody that, in Illinois in particular, most farmers, and this is true outside of Illinois, most farmers are choosing the revenue protection individual plan for corn and soybean coverage. And in Illinois, particularly central and northern Illinois, they do so at what we would call pretty high coverage levels. And so this gives you a sense for what that looks like. RP coverage in Illinois, this is sort of an acre weighted coverage level based on Risk Management Agency's summary of business data. And you can see that we basically, since these revenue products were introduced in the mid 90s, we've seen average coverage levels on those RP style products. They were called different things in the late 90s, but now what's now called RP, we've seen the average coverage levels for corn and soybeans in Illinois increase and kind of been around that 83% level since about the 2012 drought year. And, maybe a little bit of a trend downward there, Gary, since 2013, 2012. I don't know if there's much to read into that there.
Yeah, you don't know what that means, but that also was a period after SCO was introduced, so there might be some lowering and adding some SCO in very small number of cases. But what is it, 5 to 10% of the acres use SCO? And
yeah, so that could be moving the average. We've, at least in the last couple of years too, very high projected prices, and so expensive crop insurance premiums could also be explaining some of that. But again, that's a very slight decline there, kind of at the end of that series. But in general, I'd say most farmers are in that 80 to 85% coverage level. Definitely in central and northern Illinois, we see a little bit lower coverage level selection. On average in southern Illinois, we've got our one of our classic central Illinois county examples here with McLean, and then a southern Illinois example here, Saline County. Lower coverage levels in southern Illinois, we've got more yield variability down there. Actually see premium rates are definitely higher in southern Illinois, and even with the lower yields and the lower liability being insured on a per acre basis, we see even premium costs on a $1 per acre basis in southern Illinois, often even higher than in central Illinois because of those higher premium rates. But still pretty high coverage levels, even in southern Illinois, around that 75%. Most are in that coverage level. So projected prices are being determined. We are in that February price discovery period. This 2024 price here of $4.70 on corn is where we would be at if price discovery ended last week on Friday. So this is through Friday, or at least what RMA had on their website over the weekend. Had a couple lower corn settlements on Thursday and Friday last week that pushed this down even lower than what we were at if I was putting this slide together last Wednesday. But 470 is where we'd be at, and that would be 20% below the 591 projected price for corn that we had last year. Some good news and bad news associated with that. The good news would be that your premiums will be about 20% or close to 20% lower. Volatility factor will also matter here. But that also means your liability and your revenue guarantees for any given coverage level, if you're comparing how much protection, revenue protection in dollars per acre you're getting this year at any given coverage level, it's going to be 20% lower, or will be 20% lower if this is where we end up for a projected price than what it would have been last year.
yeah, and again, that will cause our premiums to go down 20%. The volatility will matter a lot, as it always does in the calculation. Right now, the volatility is setting at 0.19, which is roughly the same as 0.18, but even a 0.19 versus 1.18 will cause an increase in premium that's pretty dramatic. So
yeah, so I think we wrote a FarmDoc article last week on crop insurance, and even at a little bit higher projected price than what we see here, because it did kind of continue to move down last week. We were looking at corn premiums relative to last year in kind of the 16 to 18% lower range than they were in 2023. Soybeans, similar story, not quite as big of a decline in that projected price relative to last year, although again, things can continue to change into this week and the first part of next. about a 15% decline there. So we'd be at 1166 based on where the November futures have traded through Friday. That's again 15% below that 1376 projected price that we had last year. Volatility factor a bit higher. And so again, we'd be looking at premiums that are probably 10-12% lower than last year. Not quite 15% lower because of that volatility factor, but 15% lower liabilities and guarantees for the same policy you may have purchased last year as well.
So we have a couple questions here, and we might as well handle those right now. Some have purchased margin protection for our insurance option. It was not listed. That is true. We did not list a margin protection. By the way, you had to make the margin protection choice by September 30th of last year. So if you can't do margin protection this year anymore, I would estimate that to be about 1 to 2% of the insured acres in Illinois are margin protection. You still have an option in margin protection to add a RP or whatever the underlying margin protection looks like, RP. So that is your decision moving in.
Another question here. So in the past, we've used, looks like a situation where lower individual protection. So maybe went from 80 or 85% RP down to 75%. And then stacked SCO and ECO up to 90% on top of that. This year, the read might be that Ark County is more valuable or too valuable for corn and soybeans as an insurance supplement to use SCO. So the question is, do we agree with the benefits of choosing Ark County over PLC, kind of dominating that potential use of SCO? It's a good point. Ark County is a program you don't pay a premium for, whereas SCO is. I do think the likelihood of PLC triggering payments on soybeans is virtually zero. We'd never say zero, but virtually zero, and very low on corn. I think in thinking about the value of the Ark County program this year, it's obviously higher than it was last year. I still think the likelihood of widespread or big Ark County payments on soybeans is still pretty low. And so I think there's a stronger case there that the value of SCO, the net value of SCO, even with the premium, might still be something to consider there. But corn, yeah, I think it's a tougher call. There probably is a case to be made that Ark County might be worth not being able to use that SCO program. In that case, I'd probably still want to maybe go back and push up my individual coverage to fill that gap if you're not going to use SCO.
Yeah. So if you want Ark County, one other thing, you can still take ECO.
Yep.
So just remember, the only portion of that protection that is precluded is SCO. So if you took RP 75 last year, you could say RP 75 still have ECO. Look at that alternative. You could go up your coverage level. You would have a quote unquote little bit of a not coverage there, but again, you're getting county coverage versus farm level coverage. So if you want to get the Ark County, and I think what you're thinking about there is a valid thing to think about it, you can still do ECO. You just can't do SCO.
Yeah, and really, especially if you're at that 85% level on RP, not having SCO doesn't really leave you much of a gap. You're only looking at that 1% sliver, and it's county, not farm anyway. And so I think 85% RP plus that 90% ECO is still a pretty good one.
So here's that next question. If soybean insurance likely not to pay a payment, which in particularly in northern and central Illinois is true, why carry that insurance at all? And honestly, that's a question. That's a good question. If anything, I might, rather than not carry it at all, I might reduce the coverage level so that you still have have some coverage for those low end situations. Another thing, if you're not going to carry it at all, you might go with RPHPE, which will cover the cost, and you'll still have that very low end protection.
Yeah, and again, when I said a few times now the low likelihood of payments on soybeans. I want to clarify that I was referring to the commodity programs here, but it's a good question. It's something we get questions on quite a bit. Gary's written a bit on this in terms of the low loss ratios we've seen on soybeans nationally and in particular in Illinois, and so it's definitely an insurance program question there on whether those soybean premiums are accurate or not, or accurately reflecting the risks that we face out there. Want to keep going here, so just kind of wrap up some of our points here on crop insurance. So again, most farmers in Illinois are taking revenue protection at relatively high coverage levels. Premiums should be lower this year for the same policy, same coverage level as last year, but your guarantees are also going to be lower. And that's because of those lower projected prices that we are barreling towards here by the end of February. Another strategy here that we'll throw out that we've heard some folks talk about, we've thought a little bit about here as well. One way to increase those revenue guarantees or get them, cover a little bit more in terms of dollars per acre, and try to at least get closer to where you were at in previous years, given that those production costs are kind of sticking at high levels, at least for 2024 and probably even into 25. One thing you can do is invest those quote unquote premium savings relative to last year. So if you buy the same insurance coverage as last year, it's going to be cheaper. Again, based on those lower projected prices, you can invest those savings into bumping that coverage level up on that individual plan if you have room to move up still on that. And or look at those supplemental area plans, SCO and ECO. We'll talk a little bit more about these strategies in that more crop insurance focused risk management webinar next Monday on March 4th. But those are things to maybe think about. The one thing I will say about that strategy, your premium savings from last year, if you want to think about them that way, are probably not going to be sufficient. Well, they will not be sufficient to cover the cost of getting your revenue guarantee back up to even a level close to what you had in previous years, even if that's feasible. So there isn't a perfect or easy trade-off to get back to the coverage you had in 23, but one option there to at least get it a little bit higher than what your coverage level from last year would buy you in terms of a guarantee this year. So 2024 decisions, again, just summarize what we've kind of looked at here. Pre-harvest marketing. Again, it's boring advice, but knowing your cost of production, being able to identify any marketing opportunities that might arise and any rallies we get over the next 6 months is going to be particularly key this year. And I made the point earlier about if you are carrying a product like RP as your insurance coverage, that should allow you to be a bit more aggressive, worry less about being short on yield, and then having to fill any marketing forward marketing commitments at potentially higher prices because of how that RP program works with the harvest price. Your commodity title choice, again, most farmers are going to be in that ARC County versus PLC situation. We said kind of where we'd be leaning, looking at those programs in isolation. ARC County on corn and beans, probably PLC on wheat, but you do have to think about what you're doing on the crop insurance side of things with the SCO tie-in eligibility there needing to be in the PLC program. And then on the insurance coverage side, talked about a few potential changes that people might make in 2024, given the factors we're facing, but crop insurance is not one of those areas we'd necessarily advise anyone to look for any serious cost cutting as we look at some of those tighter margins. As we go into summer, Gary, you probably want to be looking at, again, tracking those pricing opportunities for 2024 and even ahead into 2025. And then, as you pointed out earlier, history doesn't predict the future, but a lot of potential parallels here between kind of where we're at, looking at the 24 and 25 crop years relative to the 2014 and 2015 crop years coming off kind of that ethanol build period.
Yeah, and I remember a long time ago we used to write we wrote articles about the there being advantages of pre-harvesting early. That hasn't been the case in the last 2020 through 2022, largely because during those periods, weather markets weren't dictating what was happening. If we go back to a weather sort of market, as if we have relatively good weather, higher yields, maybe even back to trend line or above trend line, which is pretty typical, we could see much lower prices. So take some of those opportunities now and price some grain.
All right, so this is sort of our attempt to maybe look ahead even at the 2025 crop year, and there's a lot of question marks on this slide. I want to make sure that's very clear. None of these numbers are set in stone by any means. And this is maybe, I would say, even a relatively optimistic view of cost adjustments that we could see. So if 2024 plays out the way we think it will, and that may change as well. But if 2024 played out like we think it will, and sort of the return levels we're projecting for this year occur, something in that range, what might we be looking at for 2025? Well, we started with our non-land cost projections for the current year, and we made an adjustment there: $75 an acre on corn, $40 an acre on soybeans. That would be kind of, a little bit of that'd be a big adjustment,
Yeah.
one. And it would be kind of, that was kind of guided. Those numbers were guided by what we saw, again, going from like 2013 to 2015 on the production cost side, where we did see some adjustments, but probably not as much as we would have liked or hoped for. It's just really hard to make a argument based on history that those production costs are going to come down a whole lot faster than that. And then even on our cash rent number, that would be $20 to $25 downward adjustment based on where we were at for 2023. Again, I think a pretty aggressive, pretty optimistic adjustment there in cash rent based on what we've seen in the past. That would put us at break evens in some kind of good yield outcomes for 2025, back below $5 break even on corn, back below $12 break even on soybeans, around 470, 468 on corn, 1120, 1119 to be real specific here on soybeans. And then we sort of laid out some kind of price ranges and kind of what we'd be looking at. So don't get ahead of myself here, but if we were looking at continued lower prices even from where we're currently at, so moving maybe into that very low $4 or even below $4 range on corn, below $11 on soybeans or $10.75 on soybeans, we'd be in a situation where we would we'd see some very quick, serious erosion of that good financial position we've built up in the last couple years. And there would just have to be some really strong cost adjustment pressures, and I think we'd definitely be in the range there where there'd be some calls for and good arguments for some additional disaster assistance, ad hoc support, which is what we've seen in the past when we have bad situations like that. If we see prices kind of where we're currently at continue, maybe that mid $4 range on corn, bottom half of the $11 range on soybeans, your owned land returns are going to be okay. You're going to have break evens to more like negative returns on rented land. That would really put us back into a 2014 to 2019 situation where we saw costs come down a little bit for a couple years, but then plateau kind of throughout that 5-year period. Or if we see something, more on the more positive price side, more in the high $4 range or higher on corn, high $11 or higher on soybeans, we'd have probably lower farm incomes than we had in 21 and 22, but decent numbers from a historical perspective. And in which case, the bad news is costs will stay up if that's what we see play out.
And just to remind us, going back there, if we're sitting in the summer and we see particularly prices at those lower ends or below 460 for corn, just to note that most cash rented farmland will generate negative returns, particularly when the cash rents are at or above the averages. So, and that leads to the projections of lower cash rents over time, but we would suggest taking that into consideration in the summer and fall as we're making those cash rental negotiation decisions.
And again, one of those things that's always easy to say, but tough to do. But I think it's, again, communication with landowners is key, and kind of letting them know kind of what 2024 is looking like may even help that conversation in 2025 if some rental rate negotiations need to occur and some of those adjustments need to play out like we think they might. So with we're gonna encourage people to throw in a few questions. We are kind of short of time, or out of time on the hour we had scheduled. But as we give you information here on some upcoming events, a chance to enter in a few questions, we'll try to get those answered here quickly as we wrap up. So while you're doing that, we do have one more webinar this week. Well, more than one webinar this week, but on this slide, we have one more webinar this week, which will wrap up our 2024 virtual IFAS series, our IFAS webinars. So that'll be this Thursday, February 22nd. Scott Irwin will be in the studio talking about the renewable diesel boom and what the future looks like there. We will be doing a second webinar in this series, or on this topic, crop risk management for 2024. That will be on Monday, March 4th. And that's when we will know that those crop insurance projected prices, and we will go ahead and get more into some of the specifics of crop insurance decisions on there. If you're registered for this webinar, you're automatically registered for that one on the 4th, and you will get reminders. The other one, and then I'll turn it back over to Todd here. The other webinar series we have going on, which we have one tomorrow in the Cultivating Caution, our farm safety and health series that's going to be going throughout most of the rest of 2024. We're doing a monthly webinar with some of our friends in the college that focus on farm safety and mental health. And so the next one of those will be tomorrow. You can get signed up for that if you're not, and you'll be reminded about all of those throughout the rest of 2024 as we do that on a monthly basis. I think through November is what we're currently scheduled out for. And with that, I'll let Todd talk about the All-Day Ag Outlook.
Yeah, the All-Day Ag Outlook is coming up. This is a conference that has been running since 1991. I was actually there, helped to organize that first one, and still helping to organize this. The FarmDoc team has jumped in along with University of Illinois Extension, the radio station WILL, willag.org as well. We have a really good meeting scheduled for you this week. This is on Tuesday, the 5th day of March at the Beef House in Covington, Indiana. No PowerPoints at this one, so it's really an interactive day, a lot of conversation between the audience and the folks that are there. The cost is just $40, and that includes the meal at the Beef House and the cinnamon rolls and the coffee in the morning. The Beef House is not open for breakfast. If you've not been around for their cinnamon rolls, they're magnificent. It's worth the trip just to come for the lunch and the meal. But the FarmDoc team will be there. We'll be talking about, again, these crop insurance decisions you're discussing today. We'll have all those numbers in. We'll look at SAF, or Sustainable Aviation Fuel, with the director for the Center of Sustainable Aviation from here on campus. I talked with him earlier this morning. Should be a really good program. We hope you will join us. farmdocdaily.illinois.edu to register, or willag.org. And again, we'd like to thank our folks that sponsor these programs. They include the TIAA Center for Farmland Research, Compeer Financial, Corteva Agriscience, Farm Credit Illinois, Illinois Corn Growers, Illinois Soybean Association, and FS Growmark. I believe there's just one question we really need to take a look at as we wrap things up. We'll thank our partners too, including U of I Extension and the Department of ACE, as well as that last slide, which tells us where we can go find these webinars in their archive. You've taken a look at that last that last question, gentlemen. What does it say, and what's your answer?
So just we had one question on the volatility of soybeans, and then the fact that it was 0.13 for
there was a typo on the slide.
2023. But here is the question: for the Ark County PLC decision, does the 125K per entity total cap? So farmers are capped at $125,000 per entity for our county PLC or commodity entitlement payments, should that lead those individuals that are closer to that cap, larger farmers, use a portfolio approach? And the answer to that is yes.
Yeah, so I mean, I think the way to think about that is the, mixing and matching across programs, putting some of your base into a PLC, which would be the program that would be less likely to pay out. That doesn't gain you anything necessarily. You still have the $125,000 cap, but what that does is it opens up more of those acres where you could go ahead and buy some of that SCO coverage, which you cannot do for acres covered under our county. And so that's a good point. And there are no payment limits on crop insurance. That's another consideration that larger farms in particular should think about for this year.
Yep. So then that shades larger farms to taking PLC and doing SCO, ECO. Well, ECO. ECO is available whether you do Arc County or PLC. With that,
we'll let Todd take us out.
Indeed. If you have questions for the FarmDoc team, you can always look their names up. You should find an email address for them, for myself as well. Send those questions along on any topic for us as they're related to agricultural economics, and I'm sure they will get back to you. And we want to thank Jim Baltz, who's behind the scenes today, making sure everything goes very smoothly. Thank you so much, Jim. And we thank you as well for being with us today. You have a great day and a good rest of the month of February. I'm farm broadcaster Todd Gleason.